Most people are completely missing where the money is going in AI. Hello, I'm Lynn, and this is Lynn's 10-minute alpha, your 10-minute edge in finding the biggest opportunities. Now, today, everyone is talking about one headline: US Iran talks. Ended with no deal. But here's the problem: most people hear that, and they immediately think, okay, geopolitical tension, bad for stocks. That's too shallow, because the real question is not, did the talks fail? The real question is, where does the money go next? And once you see that, this stops being news and starts becoming opportunity. Let's break this down. There is a very specific chain reaction that drives markets in events like this. It goes like this: talks fail, risk of escalation rises, oil supply uncertainty increases, oil prices move, inflation expectations shift, right arrow interest rate expectations change, capital rotates across sectors. That's the entire game. If you understand this chain, you don't react to news. You front run money flows. So step 1, oil. Everything starts with oil because Iran is not just a country in the news. It sits next to the most important choke point in global energy supply, the Strait of Hormuz. Roughly 20% of global oil flows through that narrow passage. So when talks break down, markets are not pricing diplomacy. They are pricing probability. What is the probability that something goes wrong next? And if that probability increases, even slightly up, oil doesn't wait. Oil moves first. So here's your first dashboard. If you want to know whether this story actually matters, don't watch headlines, watch oil. If oil barely moves, this is just noise. If oil starts trending higher, this becomes macro. And once it becomes macro, everything else follows. Now, step 2, equities. Here's where most people get it wrong. They think geopolitical tension equals stocks go down. No, markets are not that simple, because capital doesn't disappear, it rotates. And this is where the real alpha is. Let's talk about the winners first: energy. This is the most obvious one, but also the most important. If oil rises, energy companies print cash, and the fastest way to see if money is flowing there is not individual stocks. It's the ETF XLE. If XLE starts outperforming the market, that tells you institutions are reallocating. Then you zoom in: Exxon, Chevron. These are not just oil companies, they are signals, because they dominate XLE. If they move, the entire sector is being bought. Then you go deeper: ConocoPhillips, EOG, higher beta, more sensitivity to oil. And if the move continues, you watch oil services, SLB, because when capital shifts from producers to services, that means the market is no longer trading headlines. It's pricing a cycle. Now, second group, defense. If the market starts pricing escalation, defense stocks come into play. Again, don't start with individual names. Start with structure. ITA. If ITA is stronger than the S&P, that's your signal. Then you confirm Lockheed Martin, RTX, Northrop Grumman. If these names move together, this is not retail. This is institutional positioning. Now let's talk about the losers. This is just as important, because alpha is not just knowing what goes up, it's knowing what gets squeezed. Airlines. This one is simple. Higher oil means higher fuel costs. Margins get compressed. So if oil is rising, you look at JETS. If Jets is underperforming, that confirms the pressure. Then you zoom in: Delta, United, American Airlines. If they start rolling over, that tells you that the oil move is real. Now here's where things get interesting: tech. Because tech doesn't react directly to oil, it reacts to something else. Rates. If oil rises, inflation expectations go up. If inflation expectations go up, the market becomes less confident about rate cuts. And when rate expectations shift, high valuation assets get hit first. That's your QQQ. So if you see XLE up, QQQ down, that's not random. That's a macro rotation. Now let me give you a very practical framework. 3 relationships, and that's all you need: XLE versus SPY, ITA versus SPY, JETS versus SPY. If energy is outperforming, defense is outperforming, airlines are underperforming, then the market is clearly pricing geopolitical risk. If not, it's just noise. And this leads to the most important insight: not all headlines matter. Most headlines fade within 24 hours. The only ones that matter are the ones that change flows. So don't ask, is this bullish or bearish? Ask, is capital actually moving? Because if capital is not moving, there is no trade. Now let's zoom out. What happens next? There are only two real scenarios. Scenario one, no escalation. Talks fail. But nothing major happens. Oil stabilizes, markets digest, rotation fades. In this case, the move is temporary. You do not chase. Scenario two, escalation risk increases. More tension, more uncertainty, more probability of disruption. Oil trends higher. Energy leads, defense follows. Tech lags, airlines weaken. That's when. This becomes a multi week trade. And here's the key, you don't predict which scenario happens, you detect it through price. So tomorrow morning, don't open Twitter. Open your watch list. Look at oil. Look at XLE. Look at QQQ. Look at JETS. And ask one question, is money moving? Because if it is, you already know where it's going. And that's the difference between reacting and positioning. If you want to stay ahead of where the money's going, like and subscribe. More alpha coming.